Welcome to this introduction to weighted moving averages. A weighted moving average is a type of moving average that assigns different weights to data points in the calculation, typically giving more importance to recent data. Let's compare weighted moving averages with simple moving averages. A simple moving average assigns equal weight to all data points. It's slower to respond to recent price changes, but simpler to calculate. In contrast, a weighted moving average assigns higher weights to recent data points. This makes it more responsive to recent price changes and better at representing current market conditions. Let's visualize how weighted moving averages work with a price chart. Here we have a series of price data points over time. A simple moving average gives equal weight to all data points in the calculation period. For example, a 3-period SMA would give each of the last 3 prices an equal weight of 1/3. A weighted moving average assigns different weights to each period. For example, a 3-period WMA might assign weights of 3, 2, and 1 to the most recent, second most recent, and third most recent prices, respectively. Notice how the WMA line responds more quickly to recent price changes. Weighted moving averages offer several key benefits for analysts and traders in financial markets. They're more responsive to recent price movements, which reduces lag in trend identification. This can provide earlier signals for potential market reversals. Additionally, the weighting schemes can be customized for different markets and trading strategies. The weighted moving average formula combines price points with their corresponding weights to produce a more responsive average. In this formula, P represents the price points, while W represents the corresponding weights assigned to each price. The subscripts indicate the position in the data sequence, from oldest to newest data points. Weights are typically assigned in descending order, with the most recent data receiving the highest weight. This reflects the fact that newer data is generally more relevant for forecasting. The denominator in the formula is the sum of all weights. In this example, the weights sum to 15. This ensures the weighted average is properly scaled. Let's see a practical example of a 5-day weighted moving average calculation using real price data and the weights we discussed. When we apply the formula, we multiply each price by its corresponding weight, sum those products, and then divide by the sum of all weights. The weighted moving average formula gives us several advantages. It's more responsive to recent price changes, reduces lag by emphasizing recent data, and can be customized with different weighting schemes depending on the market conditions. In this section, we'll explore the most common weighting methods used in weighted moving averages. There are 3 primary methods for assigning weights in a weighted moving average. These include linear weighting, exponential weighting, and custom weighting schemes. Linear weighting is the most straightforward approach. Weights decrease in a straight line from the newest to the oldest data points. For example, in a 5-day weighted moving average, we might assign weights of 5, 4, 3, 2, and 1 to the data points from newest to oldest. The formula for linear weighting is simple. The weight for each data point equals the total number of points minus the position of the point plus 1. Exponential weighting gives even more importance to recent data than linear weighting. Weights decrease exponentially as we move back in time. For example, we might assign weights of 16, 8, 4, 2, and 1 to 5 days of data. Notice how the weight drops by half for each older data point. Exponential weighting is often formulated using a smoothing factor alpha. The weights decrease exponentially according to this formula, with higher alpha values giving more weight to recent data. Custom weighting schemes allow analysts to tailor weights to specific market conditions or analysis needs. Unlike linear or exponential methods, custom weights can follow any pattern. Here's an example where we might emphasize both the most recent data and data from 5 days ago. Custom weighting is commonly used for seasonal adjustments, volume-weighted analysis, volatility adjustments, or pattern recognition in technical analysis. Let's look at a practical example of calculating a 5-day weighted moving average using linear weights. We have 5 days of stock prices. We'll assign weights from 1 to 5, with the most recent day receiving the highest weight of 5. To calculate the weighted moving average, we multiply each price by its corresponding weight, sum the results, and divide by the sum of weights. To summarize, here's a comparison of the three weighting methods we've discussed. Linear weighting provides a balanced approach, ideal for daily price analysis. Exponential weighting emphasizes recent data, making it suitable for volatile markets. Custom weighting offers maximum flexibility for specialized strategies. Both weighted moving averages and exponential moving averages give more importance to recent data, but they approach this in different ways. Weighted moving averages use linear weights over a specific period, while exponential moving averages apply exponentially decreasing weights to all historical data. Let's look at their mathematical formulas. The WMA calculates a weighted sum of prices divided by the sum of weights. The EMA uses a recursive formula where each calculation depends on the previous EMA. It applies a smoothing factor alpha to the current price and 1 minus alpha to the previous EMA. Let's visualize how weights are distributed in each method. The WMA applies linearly decreasing weights to a fixed number of periods. The EMA applies exponentially decreasing weights that theoretically include all historical data, though older data quickly becomes negligible. For comparison, a simple moving average gives equal weight to all data points in the period. Now, let's see how each moving average responds to price movements on a chart. Here we have price data with both uptrend and downtrend periods. Let's add our moving averages one by one. The simple moving average provides the most smoothing, but lags behind price movements significantly. The weighted moving average follows price action more closely than the SMA, especially during trend changes. The exponential moving average is the most responsive to recent price changes, making it quicker to react to trend reversals. Let's discuss when traders might prefer one moving average over another. Traders often choose weighted moving averages when they want more responsiveness than an SMA, but need precise control over the weight distribution. Exponential moving averages are preferred when rapid response to price changes is crucial, especially in short-term trading and volatile markets. To summarize the key differences, WMA uses a fixed period with linear weights, while EMA includes all historical data with exponential weighting. The weight distribution in WMA is linear, while in EMA it decays exponentially. EMA calculations are simpler, but WMA offers more control over weighting. Weighted moving averages are essential tools in technical analysis, providing traders with valuable insights for making informed decisions. Traders primarily use weighted moving averages to identify market trends. An upward-sloping WMA indicates an uptrend, while a downward-sloping WMA signals a downtrend. Weighted moving averages often act as dynamic support or resistance levels. In strong trends, price frequently rebounds from these levels, particularly with longer period WMAs, such as the 20, 50, or 200-day averages. Crossover signals are among the most popular technical indicators. When a shorter-term WMA crosses above a longer-term WMA, it generates a bullish buy signal. Conversely, when the shorter WMA crosses below the longer WMA, it produces a bearish sell signal. Let's examine a practical trading strategy using weighted moving averages. This approach uses the 10-day and 30-day WMAs to generate clear entry and exit signals. This WMA crossover strategy offers several advantages compared to other technical indicators. It provides better responsiveness than simple moving averages while reducing market noise, and it establishes well-defined trading signals. Weighted moving averages perform differently across financial markets, each with unique characteristics that affect optimal WMA parameters. Financial markets vary widely in their behavior patterns. Stocks, forex, commodities, and cryptocurrencies each have distinct volatility profiles that impact how we configure WMAs. Market volatility varies significantly across asset classes. Stock markets tend to be less volatile, while cryptocurrencies experience extreme price swings. Forex and commodities fall in between. Let's examine how WMAs appear when applied to different markets. Notice how each market requires different period lengths and responds differently to the weighted calculation. Stock markets benefit from 10 to 20-day periods with linear weighting. Forex markets, which trade 24 hours, often use 12 to 24-hour periods with front-loaded weighting to capture quick moves. Commodity markets, with their seasonal patterns, perform better with longer periods of 14 to 30 days and backloaded weighting. Cryptocurrency markets require much shorter periods of 4 to 12 hours due to extreme volatility. This table summarizes the optimal WMA parameters for each market type. The key differences are in period length, weight distribution, and the market conditions they respond best to. Each market has specific considerations that influence how you should configure your WMAs. For stocks, consider earnings seasons and lower overall volatility. For Forex, the 24-hour trading cycle and economic releases create unique patterns that affect optimal WMA settings. Commodity markets show strong seasonal patterns, and supply disruptions can create outliers that require backloaded weighting. Finally, cryptocurrency markets operate 24/7 with extreme volatility, requiring shorter periods and steeper weighting to capture rapid price movements. While weighted moving averages offer several advantages, they also come with important limitations and potential pitfalls that traders should be aware of. Let's examine the key limitations of weighted moving averages. They can generate false signals in sideways or choppy markets. Despite being more responsive than simple moving averages, they are still lagging indicators. They remain susceptible to market noise and often require complementary indicators for confirmation. In sideways or choppy markets, weighted moving averages can generate numerous false signals. Here we see a typical sideways market with price moving within a narrow range. When we apply a weighted moving average to this price data, it follows the choppy movement and creates multiple crossing points. These crossings can trigger buy and sell signals that often lead nowhere in a non-trending market. These false signals are a significant limitation of weighted moving averages. They occur because WMAs react to price changes without distinguishing between genuine trends and random market noise. Despite being more responsive than simple moving averages, weighted moving averages are still lagging indicators. This means they identify trends only after they've already begun. Here we can see an upward price trend. When we apply a weighted moving average, it follows the trend, but with a noticeable lag behind actual price movements. This lag effect means traders may miss the optimal entry points at the beginning of trends, which can significantly impact potential profits. Market noise can significantly affect weighted moving average readings. In highly volatile markets, even WMAs may struggle to filter out the noise effectively. Here we see a market with significant noise. A 3-period WMA follows the price too closely and gets affected by the noise, creating multiple false signals. Using a longer period WMA, shown in green, helps smooth out some of the noise but increases lag. This highlights the trade-off between responsiveness and noise reduction. To mitigate these limitations, traders can implement several strategies. Combining WMAs with momentum indicators like RSI or MACD can help confirm signals. Using multiple WMAs of different periods can provide better context. Applying filters can reduce false signals in choppy markets. And confirming signals with volume analysis adds another layer of validation. Here's an example of how combining a WMA with RSI confirmation can improve signal quality. The green circles represent entry points where both the WMA trend and RSI confirm the signal, significantly reducing false positives. To summarize, while weighted moving averages offer improvements over simple moving averages, they still have important limitations. They generate false signals in choppy markets, lag behind price movements, are affected by market noise, and work best when combined with other technical indicators. Advanced weighted moving average strategies take the basic concept to new levels of sophistication and effectiveness. One powerful approach is using multiple WMAs with different periods simultaneously. When we overlay WMAs of different lengths on a price chart, we can identify stronger signals. A shorter period WMA crossing above a longer one often indicates a bullish trend change. WMA envelopes create bands above and below the main WMA to identify overbought and oversold conditions. Typically set at a fixed percentage from the center WMA, these bands create a trading range. When price touches the upper band, it may signal an overbought condition. Conversely, touching the lower band may indicate an oversold condition. Developing custom weighting schemes allows you to adapt WMAs to specific market conditions or trading styles. While linear weights increase steadily and exponential weights grow more rapidly toward recent periods, custom schemes can incorporate seasonal patterns or volatility adjustments. When implementing advanced WMA strategies in your trading, consider these best practices. Always backtest your strategies across different market conditions to ensure robustness. Combine WMAs with other technical indicators for confirmation and optimize parameters for your specific timeframe. WMA crossovers can provide strong confirmation of trend changes. And remember to adjust envelope percentages based on market volatility, wider in volatile markets and narrower in calmer conditions. Most importantly, successful WMA strategies require rigorous testing, continuous refinement, and the ability to adapt to changing market conditions.